For some people, buying a house is one of the biggest goals of their lives. But what if we tell you that buying a house can prove to be your biggest financial mistake? Don't take our word for it. We have financial experts like Kiyosaki and Tony Robbins backing our statement. Welcome back to our channel. In today's video, we will show you why you should not buy a house. For a majority of people, buying a house is more like a liability rather than an asset. We will also tell you how a house can become an asset. Without wasting any time, let's get started. Number 1. Commitment to stay in one place. Purchasing a home allows you to establish roots in one neighborhood. However, in an unsteady economic and job market, this is not an advantage. With the world still in turmoil as a result of the pandemic, supply chain concerns, and the Great Resignation, the ability to relocate for work is more crucial than ever. If you have a mortgage, you may miss out on a better paying career or the opportunity to relocate to a lower cost city. These opportunities may easily outweigh the growth in the value of the home you purchase while your existing condition. Be honest with yourself and consider your future plans. Are you in a place in your life where you want to be? Keep in mind that having a house in one location means you'll be spending the majority of the next few years there. If you still want to be flexible, travel to new places, or live somewhere else, buying a house is not for you. You may be bound by a lease if you rent a house or apartment. Leases, on the other hand, can be quite short, typically lasting only 12 months. When this expires, you can pack your belongings and relocate to another location without losing much. Number 2. You own a loan, not an asset. A lot of so-called financial experts claim that owning a house means that you own an asset, whereas reality is quite the opposite. In the words of famous finance author Kiyosaki, an asset is something that puts money into your pocket. If you own a house in which you live, it is not really an asset. It's a liability as it takes money out of your pocket in the form of mortgages, repair costs, utility payments, taxes, etc. Moreover, if you have taken a home loan, you don't even own the home yet. It's the bank's property. In simple words, your home is an asset for the bank and a liability for you, as it takes money from your pocket and put it in the bank's pockets. And with rising interest rates, it makes it even more beneficial for the bank and equally more cash draining for you. Number 3. Houses aren't liquid. There's been a constant rumor of a market crash for the past few months, but even if the market does not crash, you may find it difficult to sell your home as quickly as you would like. It will take time and money to prepare your home for sale unless you have meticulously maintained it. And if you over-improved or failed to keep up with local trends, you may end up selling for less than you expected. Because housing prices vary by neighborhood, expecting a specific amount of money from selling your house in a specific time frame is unwise. If you require cash, mutual funds, stocks, or even the best high-yield savings accounts are investments that provide you with access to your money while allowing you to choose your own level of risk and return. So even if you are planning to sell your house later, it might not go as you planned. Number 4. The housing bubble is about to burst. Housing price increases are uneven across the country, implying that some markets have reached the pinnacle of a housing bubble while others still have room to expand. Recent research crunches the numbers and creates maps and charts that show almost all areas in the USA are most inflated and on the verge of bursting. It's important to note that just because a market isn't among the top 10 most overpriced in the country doesn't mean it won't fall at any time. And the 2008 housing market crash is a living proof of why you should not buy a house just because you feel like it. Number 5. Losing opportunities. When you invest the majority of your money in a home, you miss out on other potentially profitable investment opportunities. You could have invested that money in stocks and bonds and earned a nice passive income without any financial risk. In fact, history has shown that a diversified stock portfolio outperforms residential real estate investment performance by a significant margin. Finally, consider the possibility that the market value of your home will fall. If you buy a home now with a 20% down payment, you may lose out if the local market drops by only 5%. This way, you lose a quarter of your investment while gaining little. By now, you might be wondering that there are a lot of people who are still making money by flipping or renting houses. And for them, a house is really an asset. So, how can a house be an asset? If you buy an investment property, it needs to earn more money than its cost to maintain to be classified as an asset. Otherwise, it's a liability, and the same is the case for the house. If you're able to rent the house at a higher price than the expenses such as mortgage payment, real estate taxes, insurance, utilities, and maintenance, it becomes an asset that increases your cash flow and brings those bucks into your pocket instead of the bank's. So if you are planning to buy a house, make sure to take into account the points mentioned in this video and make a wise decision yourself. Thank you for watching this video till the end. We hope you enjoyed it, and if you did, don't forget to like the video and subscribe to our channel so that you never miss another amazing video from us. Do you have any other tips for people looking to buy a house? Let us know in the comments section below. We will see you in the next video.